Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking reporting season and how did those companies go. We've got Chris Stott from Wilson Asset Management and Karl Seigling from Cadence. Welcome, guys. So, Chris, conditions. Are we in a good spot? Are companies shooting the lights out, or is it a lot tougher out there?
It's a lot tougher, Matthew. Conditions remain patchy. The economy's not great. Retail was the shining light, though, in reporting season. A few retailers certainly surprised on the upside, and a few of those will report throughout September, and if those trends continue, all bodes well for them. The expected decline in mining came through, probably a bit more fierce than some had predicted, and outlook statements, as always, were guarded, but more so this time. So AGM season probably holds more weight than it did in previous years for this year, in our view.
And when you say retailers, there's different types. Any types in particular?
Apparel.
Food, apparel.
Apparel's going really well, Matthew. We've had a cold winter. A lot of retailers moved their stock early at full price, so less discounting. Whereas on the food side, it remains quite tough. We've seen Woolworths' result disappoint there. Metcash is struggling while Aldi continue to take market share.
Okay, Karl, did you see that as well, or you found another little niche that's going well?
I'll just take up on Chris's thing with the resources. I mean, it was bad, but it was worse than that. It was really, really bad. Mm-hmm. So BHP had the worst result in 11 years. Fortescue looks like they're not going to make money. Atlas Iron Ore looks like they're going to go broke. Rio's got 75% of the earnings in iron ore, look like they're about to dissipate. And we're seeing some of the South American effect now of increased supply. I think that the resource thing looks really, really bad.
Okay, so we can sidestep that.
Okay, so now on to what looks really good. For me, it was just a little, specialist stories are the only things that I thought looked particularly
individual
good.
stocks.
For example, IPH, a patent attorney business, fantastic result. We're holding Melbourne IT, a turnaround story. For the first time, actually, it's not just a belief story, it's actually real cash flow turnaround. So there's something there, we think. Some of the diversified financial services companies continue to do well. That trend continues. But generally speaking, it was a very ho-hum reporting season.
Okay, Chris, always with professional investors, we're looking forward. What was the outlook commentary like in general?
Very poor. A lot of companies kept their cards close to their chest. A lot cited that conditions in the fourth quarter of last financial year weakened in some cases. So AGM season will be quite negative, we think, and particularly maybe even in October, some companies may be looking to update the market with trading updates into that particular period. But we can't see the Australian economy really changing much over the next 6 to 12 months, given the outlook for interest rates remains fairly steady. We're still adjusting to the end of the mining boom, particularly the fiscal hit that's coming through. So really it's hard to see a catalyst, if you like, to really spark the economy from here, short term.
Karl gave us a couple of stocks, one that you thought did well and the outlook looked okay.
Smart Salary was one that looked quite well, good to us. Packaging business, Minnie McMillan Shakespeare, as we like to say, re-rated now from a P of 7 to 14. We still think the earnings can grow quite strongly from here with net cash on the balance sheet. And the Reject Shop was another one that we held that did quite well. Turnaround story, really poor management team were there, poorly managed business historically. They're fixing the stores now, they're getting the right product on the shelves. They can manage the fall in the Aussie dollar over the next 1 to 2 years. So they were probably the two standout results for us.
And for those people who are short, Karl, give us one short.
Fortescue, it's $9 billion of debt. Losing money on every tonne of iron ore that they export, and a very precarious situation to be in if iron ore prices fall.
There you go. It's not too rosy out there, but there's always a stock or two to invest in.